Good morning and welcome to another edition of the National Stock Exchange and Cnbc TV 18's Investothon, an initiative that began back in March 2011 when investors and other stakeholders from India's investing community ran on the iconic Bandra Worli ceiling. Well, this is our second season and the second leg of our Investothon. Today, we're in the temple city of India, Bhubaneswar. And on the other side, on this screen, you can see some pictures there. They're just ready to flag off our first run of the day, the 4-kilometer wealth run. As you know, there are three runs. It's a community run. There is not just one winner. Everyone wins at the Investothon. We have the 4-kilometer wealth run, the 2-kilometer health run, and the 1-kilometer power run. This race should be, the first run should be flagging off in about under a minute. We have two very special guests in our studio this morning with me, bright and early Sunday morning. Samantha Dugal is our yoga and wellness expert. Samantha has over 10 years of experience in yoga, dance, wellness and other things, other fitness activities. Good morning, Samantha. Welcome to the show. And we also have Hemant Rustagi, who's the CEO of Wiseinvest Advisor, who has over 17 years, you've been in the financial industry for over 25 years, right? And the mutual fund industry for more than 17 years. Hemant is someone who you've seen regularly on CNBC TV 18, who's giving sound financial advice always. Good morning, Hemant. Welcome to the show. So we're just about ready. Bhubaneswar is a good 20 degrees Celsius, perfect weather to run, not too hot, not too cool. And Bhubaneswar is all charged up, all the people. And as you can see, there's it. That's the first flag off for the morning. The 4-kilometer wealth run is off. Enthusiastic and energetic runners there in the morning. So, Samantha, let's start with you this morning. Fitness. Let's talk about health rather. And how is yoga placed in health? What's the importance of someone to do yoga?
I think being a yoga and a wellness practitioner for the last 9-10 years, it's actually a way of life, and it's upheld by correct exercise, correct eating food habits, correct thinking, enough relaxation, positive thinking, meditation. So it's made up of a whole gamut of different things. It's not just about only exercise or only about right food. There's a whole lot of things which make up the practice. Yeah.
Okay. And Hemant, coming to you for sound investment, for someone to soundly manage their financial and their investment portfolio, basic rule, basic foundation ground rule. What's the #1 rule of good investment?
I think there are a couple of things that investors need to look at. You know, the problem with most of the people is that they start investing without having any investment plan. You know, starting your investment without a plan is like traveling without an itinerary. So I think it's very, very important for everyone when they start investing to plan for investment.
Okay.
But there are some very simple steps. It may sound very overwhelming for investors, but I think it's a very simple process. What they need to do is to just look at a couple of things. One is decide what are their investment goals. All of us have goals. Some of the goals you want to achieve in 2 years, some in 5 years, some in 15 years. So define all your goals. Assign a time horizon for each one as to how much time you have to achieve them. And then also give a target to each one of them. For example, if someone is planning for retirement, he may need 1 crore. For child education, he may need around 25 or 50 lakhs, depending on what your targets are. So you need to consider inflation there. Because if you work out everything as today's cost, and if the education is going to cost 25 lakhs, and you need it after 15 years, I think there's going to be a huge gap. So look at inflation, look at these steps. These will help you in terms of deciding your asset allocation. Right. What is asset allocation? Basically diversifying your portfolio into different asset classes. You have gold, you have real estate, you have equity, you have debt. Now how do you decide that? Long-term money has to be invested in options like equities because you need to beat inflation. That's very, very important. Equity tends to be very volatile over the short-term period. So avoid investing in equity for short-term, invest for the long-term. In the short-term, look at debt options. Why? Because the focus has to be on keeping your money safe. So decide your asset allocation and then thereafter look at options which are tax efficient. Why tax efficient? Because there is something called real rate of return. You have nominal return minus inflation minus cost. That has to be positive. So for example, if you're earning 7% and your inflation is 7%, then you're also paying tax. You're actually negative return, which means over a period of time, even though your numbers will, money will grow in numbers, it'll actually go down in terms of value. So I think these are simple steps that investors need to follow.
Okay, that's very. Coming to you, Samantha said about, was talking about instant gratification in health. Now I'm sure, and I know that's one thing that happens a lot in the financial market. Everyone's like, today's Sensex up, I want to put in money. Tomorrow I want to make like 10, 20, 1,000 times what I've put in. How do we deal with that?
Well, Samantha talked about, a couple of months. I'm saying investors want return on a daily basis. I think it's very important, like I said earlier, investors to realize that investment is not one-time activity, it's a process.
Yeah.
If you're looking for shortcuts, if you're looking at, stock market as your ticket to basically, get overnight riches, this is not the place to be in. The problem is, for example, if you look at gold as an asset class, the gold has been doing very well. Now the point is, when an asset class is doing well, everyone wants to put money there. But you see the difference there. Okay, if you really break it into last 4 or 5 years, the first 3 or 4 years, gold did very well. Last year, if you look at gold, it didn't do very well. So if you are really getting influenced by the performance of a particular asset class and you invest all your money in that, suddenly you see other asset classes doing well and then you don't know where to go. So I think it's very, very important to look at what is going to suit you, like I mentioned earlier about. You look at your asset as an asset allocation. If you're investing for the short term, look at the right asset class. If you're investing for the long term, look at the right asset class. By all means, it doesn't mean that gold should not be in the portfolio. It should be in the portfolio. But all the asset classes have a place. Right. Even real estate, for example. I'll give an example of real estate. Everyone thinks that real estate is a place to make money. Yes, it does. And it is it has to be an integral part of your portfolio. But believe me, if someone who invested in equities for the last 15 years, and if they held on to their investments, I think the returns are much, much better. I mean, I can tell you, even mutual fund, for example, last 15 years, if somebody has been invested regularly, the returns are 25, 26%. Okay, so I think they're comparable with any other asset class. The point is, if you are expecting the same kind of return from equities in 6 months or 1 year, well, that is not going to happen.
Maintaining a fixed investment plan. So people do make a plan, they decide they'll stick to it, they stick to it for a couple of weeks, a month, and then there's a spike in either gold or in the stock market or in real estate, and things just go array. How do you get people to control that urge to just, go with the flow?
Well, it's a very difficult task because, like I said, everyone wants the best. So, if gold is doing well, I should get the maximum return from there. If equity is doing very well, I should get the maximum return from there. But that is not how it works. Because every time you want to switch from one asset class to another asset class, you're basically trying to time it. And believe me, even the best of experts in the stock market can't do it. Maybe they will be successful once in a while, but they can't do it every now and then. So investors need to realize, like I mentioned earlier, investment is a process. You decide where you want to invest, stick with it. For example, if you're investing in equity for 20 years, now the more volatility it is there in the market, the better it is for you, because every time you see the market going down, you get more units for that. So continue your process. Don't keep on switching from one asset class to another asset class. And I think the most important thing is to start investing early. Many investors do not realize the importance that the power of compounding works only when you start investing early. If you give your money 25 years, 30 years, compare it with 20 years, I think that will make a hell of a lot of difference. Start investing early, continue with the process, stick to your asset allocation.
Okay, I'll get back to you on the Kashmir very shortly. Hemant, you were talking about the compounding, about the importance of investing early. So how early is a good time? I mean,
well, there is no good time or bad time. Okay, I mean, a youngster, when he starts working, you can't expect him to really think about retirement at that point of time. But the fact is that if you start investing, start putting aside a little bit of money, it'll make a big difference. I'll give an example. I mean, someone, for example, let's say invest 6,000 rupees, okay, for a period of 30 years.
Yeah.
He'll get to around 1 crore. I'm assuming a return of around 12%.
Okay.
But if he invests,
which is fair enough considering
absolutely. I think that I mentioned about long-term returns have been much, much better. But if he reduces his time horizon by 5 years, it'll be 54 lakhs. You see the difference there.
It's almost half.
So the more time you give, that is what is the beauty of power of compounding. What investors don't realize is that every time there is a volatility in the market, they want to take out money and then go into debt and see that if they can make better return there and come back into equity. Now what happens is, if you study the stock market, maximum benefits of the stock market will come on very few trading days. Now, for example, if you're not in the market on those trading days, you've lost it. So I think it's very important to invest and continue that process and remain invested. I think then only you can get the benefit from each of the asset classes.
Okay, and you know, it's a very good thing that then you said, I'll get back to you on that. I have another point earlier about, you know, there's no right age to start investing, the earlier the better, and there's a initiative that National Stock Exchange and CNBC TV18 have come together, and we're doing, it's in the second season in fact on television. It's called the NSE Financial Quest Quiz. It's the second season, which you must be watching on air. It's on air Saturdays and Sundays, where it's a quiz show for students of 8th, 9th and 10th standard, based on finance. So the great thing is we get a really good response. These kids are really knowledgeable about all this. So I think the multiple avenues of financial information that's available to people, I think that helps a lot.
Well, definitely it helps a lot. You know, what happens is, like we were discussing earlier, if you start investing at the age of 30, you're not very familiar with how to invest, you're not familiar with asset classes. Now, when as a kid, when you're familiar with how the financial markets are working, you have the information, you have the knowledge about how different options are there and what exactly they need to do. And in fact, what we're seeing now is that many youngsters have started investing now, you know, small sums of money, even their pocket money. What really happens is you may not have a large sum of money to invest, but when you start investing at an early age, you become comfortable with an asset class. You know, especially when we talk about equity in the long run, because equity is an asset class which requires, you know, you to have patience and also the discipline.
Right.
If you really become familiar with, you know, equity as an asset class with a smaller sum of money, later on when you become a serious investor, it's much more easier for you to take the risk that comes with it.
Okay.
So I think it's a very good step. It's a great initiative that, you know, even through the quiz, if they can enhance their knowledge, I think they'll go a long way in making them a good investor.
And I think, like you mentioned, investing in small amounts. So I think SIPs are really helpful to people who want to invest regularly. I mean, is it advisable to go in for SIPs or just invest a lump sum at one point of time?
Well, I think you can't say that SIP is a better way. Okay. SIP is definitely a convenient way. Why it is convenient is, if you do not have a large sum of money, what do? You can't be waiting for you to have a large sum of money and then start investing, because you lose out. Like I said earlier, power of compounding works only when you have time on your hand. So you begin your investment every month. And equity being a volatile asset class, you know, it requires that you maintain that discipline. And because when you maintain that discipline, you invest on a regular basis, it helps you in terms of averaging. And SIP also is important for an investor because it brings a sense of discipline in your way how you invest. So it's not only about, unfortunately, whenever we talk about SIP, everyone thinks about equity funds. SIP need not be done only for equity funds. Equity funds only when you have a longer term horizon. Even when you have, you know, short term horizon, 5 years, maybe less than that, there are variety of debt funds which are available from mutual funds. You have, you know, short term debt fund, you have income funds, you have MIPs. Invest in those. SIP does not necessarily mean that it has to go into equity. Look at which kind of fund is going to suit your time horizon and then continue. But the important point is, once you start the process, continue with it. Don't stop in between.
Okay, that's a very important point. That's a very important information, that SIP is not just your equity funds. There are other options. There are other avenues where SIP is used. Good morning. You're watching National Stock Exchange and CNBC TV18's Investothon. This morning we're coming to you live from the temple city of India, Bhubaneswar in Orissa. Good running weather, about 20 degrees Celsius. Enthusiastic participants down on ground in Bhubaneswar. As you can see, most of them have finished their runs. We had 3 runs, the 4-kilometer wealth run, the 2-kilometer health run, and the 1-kilometer power run. And joining me in the studio this morning are 2 very special guests. We have Samantha Duggal, who's a yoga and wellness expert, and we have Hemant Rustagi, who's the CEO of Wiseinvest Advisors. Good morning, guys, again. Hemant, I'll come to you. There is a lot of in the news. There's always news about maybe the RBI is changing its rates. How important is that for a retail investor who's looking for a medium to a long term, and he's investing in multiple avenues? So this news on the news channels, there's a lot of excitement when the RBI is announcing its rates. How much does it affect a retail investor?
Well, I think RBI announcing rates is part of its monetary policy, and I think it impacts retail investor in more than one ways. It's not only about investment; it's also about, you know, how they're going to pay interest on different loans that they take. For example, if the interest rates go down, obviously it's a good news for all those people who want to take housing loan or auto loan or different kind of loans. But as far as the investment is concerned, I think it has a different implications altogether. So a general perception about debt is that, you know, you invest in debt and you forget about it. I think the times have changed. Today, I think you need to manage your debt funds more actively. as against an equity fund. Unfortunately, investors manage equity fund more actively, which is not the right thing to do. Okay. That is basically a long-term investment. On the debt side, why you need to do is because we need to understand that there is an inverse relationship between interest rate and the bond prices. Now, what it means is when the interest rate go down, the existing bond prices go up. And the reason for that is because the new bonds which are there in the market are offering lower return. So the earlier bonds which are there, because these bonds are listed, suddenly the demand goes up, everyone wants to buy those bonds. Okay. So whenever the interest rate go up, the existing bond prices will go down, which means that if you're an investor in an income fund, okay, the good time is to invest when the interest rates are going down. Okay. Because that is when the NAV of the fund will go up. Okay. But if you're investing in some other options like bank fixed deposits, that's the time it will start getting lower return. So it has different implications for different kind of products which are there in the marketplace. Okay. Like I mentioned earlier, investors need to realize that you need to realign your debt portfolio in line with the interest rates. Otherwise, if you've made gains, you will lose out if you don't realign your portfolio over a period of time.
So how important is, in today's life, where people are working so hard, most of the day goes in working, is it advisable for someone to get a good financial advisor to help them with their portfolio, or should we, is it good enough to manage on my own? Should I get a financial advisor, or should I manage my own investment portfolio?
Well, if you feel you can do it, but it's not only about your feeling. You should have the capability to do that. Now, let's understand, when we talk about an investment portfolio, all the dreams you have about yourself or your family are all linked to the money. Okay? You can't do anything in life without money. Sure. Now, if you want to make your money, grow at a decent rate, or in a healthy manner, you will need definitely professional help. You don't want a situation where you don't want to learn the hard way. Investing in something which you don't know whether it is right or wrong, and suddenly you realize that you've risked your, capital. It's very important to get a good financial advisor, okay? But it does not mean that if you have a financial advisor, you go to sleep. You need to actively participate. Now, somebody can turn around and say, look, because I don't have knowledge, that's why I have a financial advisor. What can I contribute? No, I think what you need to do is ask questions which require common sense. You may not be a financial wizard, but you care for your money. You understand what your needs are, what kind of investor you are. You participate in the process. Ask questions to the financial advisor. I think that is how you grow as an investor over a period of time. But spend time in finding a good advisor. How do you find one? Talk to your friends, okay, but don't give money just because somebody says, he's a good advisor. Right. Find out what kind of money he's managing, how many investors he has, how much experience he has, what qualification he has. Look at all these factors. You can still go wrong, we can in, other parts of life. Client. But I think be careful in terms of selecting a financial advisor. Spend some time. Otherwise, generally what I've seen, investors will, somebody's referred and they start, dealing with that person. So I think spend some time in finding a good advisor.
Okay, those are wise words from Hemant right here on the Investothon. We're coming to you about insurance, which is, I think, my personal, I don't know if I'm correct or wrong, but it's something that people don't look into so much. By insurance, by way of life insurance, as well as general insurance for your house, for your car. What's your thoughts on insurance? Important? Is insurance important? How important?
Well, yes, Hemant, you're absolutely right. Most of the investors, most of us think that nothing is going to go wrong with me. And generally the perception is that money that I'm going to spend on payment of premium, insurance premium, is going to be a waste. So why do it? But I think risk management is what I call it, is very, very important aspect for anybody's life. When I talk about risk management, I'm basically talking about ensuring that you have adequate risk cover for your life, your health, and your property. Now, what typically happens is, we just talked about earlier, that all your dreams are linked to the money that you accumulate over a period of time. But that you can do as long as you're there. If in some unfortunate event the person is not there, the dreams are still there, the responsibilities are still there. So I think anyone who has dependents must go for a life insurance cover. And here again, I think the key is to take it as early as possible. The reason for that is that if you've taken a health insurance at a very young age, the insurance companies can't come back and tell you that you had this disease earlier because you have been paying premium for so many years. And even for life insurance, the important aspect is when you take life insurance at a young age, your premium is going to be much lower. But the important thing is, look at the right product. What mistake investors make is, there are very few people who go for insurance. When they go also, they look at products which are a mix of investment cum insurance, which is like these typical endowment or traditional fund products. These are not the right products. Go for a term plan, because it's not only important to have insurance cover, it's also equally important to have adequate amount of risk cover. That can come from term plan, because one, you get higher cover, and second, the premium is very, very low. So in terms of life insurance, look at term plans and keep your investment needs separately. In terms of health is equally important. You know that today the health treatment has become very, very exorbitant. So I think it's very important to look at health cover too. And of course, it's very important to protect your capital, the properties that you build over a period of time. So I think risk management is very important. In fact, I would say before you start investing, ensure that you have taken proper risk cover and then only start your investment.
So what Hemant is saying is one of the key pillars of a good investment portfolio should also be insurance. So you definitely need to look at insurance as a part of your investment portfolio. You're watching National Stock Exchange and CNBC TV 18's Investothon, coming to you live from Bhubaneswar. We'll go into a short break. Don't go anywhere. We'll be right back. Hemant, I want to talk to you about when you talk of investment, there are a lot of traps or mistakes that some investors could make or others have made. Just tell us a little bit about some common mistakes and traps that people might have made that people watching, viewers at home should avoid.
Well, there are two kinds of investors that we have in the marketplace. One set of investors are the ones who do not start investing, thinking that, as I mentioned earlier, they don't know how to start investing, or sometimes they think that we don't have enough money to start investing. Don't make that mistake of delaying your investment process. Begin as early as possible. Today it is possible to start investing even with 1,000 rupees per month. So that should not be the excuse that because I don't have enough money, I can't start investing. On the other hand, you have investors who start investing but do not plan their investment. They start investing in a very haphazard manner. Now what typically happens, someone comes and says, this is a good product, invest in that, this is a good asset class, invest in that. Now over a period of time, what happens is, they have a portfolio which either takes them beyond their risk-taking capacity, which is not good at all, or they make their portfolio very, very conservative, which means that they actually struggle to beat inflation. So don't make that mistake. When you start investing with a proper plan.
I'll just come back to you, Hemant. We have Ashmit on ground. Lovely messages, lovely to hear from the people on ground. Closing comments, guys. Samantha, tell me 3 things that people need to do, people who are starting into fitness, to make sure they go down the correct fitness path.
I think we haven't touched upon correct food habits. People are into fat dieting and only eating proteins or only eating carbs. And I would say that please combine like proteins, fats, carbs. Fats are a huge source of energy. Don't ignore that. Conscious relaxation. Taking a pause and just auto-suggesting yourself, or learning it from a teacher to just consciously relax, not sleep. Okay, that's a different thing. Yes, just step back. Just taking a moment for yourself. Exercise we've already spoken about.
That's true. And Hemant, coming to you for a last closing comment. 3 things that people need to do correctly to invest correctly.
Well, I would say, I think the first important thing is, like I mentioned earlier, start investing early. Second is look beyond traditional options. Okay, today the times have changed. The traditional options are giving you very low return. Look beyond that and monitor your portfolio. Do not just invest and go to sleep. Keep monitoring your portfolio. Don't be afraid of making changes if you've gone wrong somewhere.
Okay, great. Well, that was wise words from the CEO of Wiseinvest Advisor. Thanks, Hemant. Thank you, Samantha, for joining us. You've been watching National Stock Exchange and CNBC TV 18's Investothon, coming to you live from Bhubaneswar. We'll be back very soon in another